Most individuals, obviously, we know that when we talk about money, folks, we talk about candy. I'm a big guy. I love food. It's an easy illustration for me to remember. The investments that you purchase, and that's can be from anything from in stocks to cash to real estates, alternatives, all that stuff. We call it candy, right? That's the stuff you put in your investment vehicle. And then you can have wrappers around that, exchange traded funds, mutual funds, and there's tax wrappers around that. And so we're going to focus on the tax wrapper and what those internal candy instruments do and how they can affect your income. So, Jamie, getting into gains, so let's go through a couple questions. Number one, what are capital gains and how are they broken out?
Sure. So with capital gains, you can think of that as you make an investment. So that's the capital. The capital is the money that you put into a certain investment. The gains then is what you make off of that capital that you invest in. So say you buy a stock for $100 and that stock goes up to $200. That $100 difference, that is the gain of that stock that you've purchased. So with capital gains, they're taxed in a special way. So they have what is called preferred tax. So you have your income tax where you pay at a certain level, and then you have the capital gains tax. If you are in a 12% tax bracket or lower, then you don't have to pay any capital gains taxes. If you get above that 12% tax bracket, say to the 22%, and you have capital gains, that gains will be taxed at 15%. So it's at a preferred rate.
And that's long-term capital gain.
Yes,
so let's preface that. So long-term capital gains, they're preferential. You want them. And in order to get a long-term capital gain, you have to hold the asset for more than 365 days, right? 12 months, baby.